Market volatility has put unprecedented stress on the U.S. trading system. Friday saw the largest dollar volume trading for U.S. equities in history. $986 billion changed hands. That's according to Goldman Sachs. That's nearly 3 times normal levels. So that kind of trading volume catches the attention of the SEC. Joined now by Brett Redfearn, Director of the Division of Trading and Markets for the SEC. He's been monitoring all these record trading volumes to make sure the system is still running smoothly. Brett, thanks for joining us. What is the verdict? How is the U.S. trading system holding up?
I'll tell you, Bob, we've been seeing some pretty extraordinary market activity. You mentioned the high volume that we saw on Friday. I think one thing we look at very closely is the message traffic that you see in the market. In some cases, we've seen message traffic actually doubling. And I will tell you, our markets have held up very well. They've been orderly, they're functioning well, and we've seen very few technical issues, very few system glitches. Yeah. And fundamentally, I think the verdict is our markets are demonstrating remarkable integrity and resiliency.
Well, that's certainly good news, but I guess why? We've had issues in the past. We had systems come down. Is there something new the SEC is doing or the exchanges are doing to have more robust connectivity, less issues?
It's a good question. And, I think we all remember times in the past when we saw more outages and glitches and things like that happening. And it's pretty impressive that we're not seeing that right now. I think the exchanges have made a significant amount of investment in the infrastructure. And I would also say the SEC's put a number of different rules and other procedures in place. For example, one is called Reg SEI. It stands for Systems, Compliance, and Integrity. Yep. Reg SEI says you have to have backup systems, you have to test your systems, you have to make sure your systems are resilient and are capable of handling a lot of message traffic like this. So I think those things are helping.
Okay. And Brett, you are in regular touch with other government agencies. I know you meet with them regularly to discuss about market traffic and what's going on with the Fed and with some other government agencies that are out there with Treasury. Can you characterize your meetings in the last week with them? What have you been discussing and what have they been telling you?
I think it's important to point out that we do talk on a frequent basis. We talk to the Fed, we talk to Treasury, we talk to other regulators of financial markets like the CFTC. I would say that those meetings have definitely picked up in the last week because, we're seeing a lot of things. What we try to do is we try to share observations. What are you seeing? What are the potential risks that you see? And so that kind of communication and cooperation, I think, is very helpful. And I would say that it's a very good working relationship across the official sector.
Leon Cooperman, who's a frequent guest here, was on last week, and he called for bringing back the Uptick rule that went away several years ago. Have you ever looked at this? Is there a reason why we should consider bringing it back? Is there a position from the SEC? And would it do anything if we did bring it back?
So I think one thing, Bob, and I think you know this, we did put in place an alternative Uptick rule. It's called Short Sale Rule 201. So we have a mechanism in place to make sure that short sellers at a certain point aren't sort of pushing the market down. So effectively, if the market's dropped by 10%, then short sellers can't actually hit bids. They have to post on the offer side of the market. That slows them down. And that's an initiative that was put in place after the financial crisis to help deal with those concerns about short sellers.
And last question, Brett. We've had very high volatility, and often traders come on, they complain about a lack of liquidity, where the market makers, the bids and offers, bids and asks tend to dry up in times of high volatility. Has the SEC ever studied this? Is this a real phenomenon? Do you believe it exists? And is there anything the SEC can do about it if it does exist?
So we look at a lot of things in the market, Bob. We're looking for limit down halts. We're looking for, what we call self-help declarations. And we're also looking at, sort of micro bursts of activity that can cause liquidity gaps in the market. And sometimes that may or may not relate to, market participants that are out there. You also know that we're talking to market participants all the time. So we're calling banks, exchanges, market makers, clearing firms, and that's part of our monitoring effort as well. So, we're not seeing market makers pull out of the market. I think the best way to characterize it is while people might not always like the prices that they see, there's always buyers there, there's always sellers there. People who want to get something done have been able to get it done.